Hello and welcome to Financial Education for the Nation. My name's Warren Shute, and today, negative interest rates. Not the mortgage positive thing you might think. This episode has been sponsored by Idelo, the price comparison website. Okay, so what do I mean? What's that babbling on about? How are you? I hope you're well. I hope you're keeping safe and I hope you're keeping busy. This week, it's got warmer, so I'm much happier. The sky is brighter. It's looking good out there, which is always good for the soul. Get out and move about. I've just come back from a nice walk, which is great. The Bank of England has given retail banks 6 months notice to get operationally ready for negative interest rates. So I wanted to cover this so that you were aware of what's going on. So we have retail banks, which is the likes of the high street banks that you and I would use, Barclays, NatWest, Lloyds, HSBC, includes the building societies. And you've got the central bank, which is the Bank of England. So we've got to differentiate between the two because they are separate bodies. And I think sometimes people will just merge everything into one. So the central bank, the Bank of England, is the bank of banks, basically. And it's told retail banks to get ready if they take their rate, the Bank of England rate, negative. They've given them 6 months notice for this. So first of all, why would the Bank of England take interest rates to negative territory? The main reason, almost I would say the sole reason, but I kind of don't want to say that because I get caught out, but certainly the main reason is to stimulate the economy. So the bank has various levers, various controls that it can do to slow an economy that is speeding ahead, and it would want to do that in case to stop inflation racing away. So when an economy is booming and everyone's spending money, prices start picking up and therefore inflation picks up, and high inflation isn't good for a currency. So it increases interest rates to slow people spending, and it has that effect because if you think about it, if your interest rates on your mortgage go up, your monthly payments on your mortgage increase, and you can't then afford to spend so much money because you're paying more on your mortgage, but also interest rates in the bank are quite attractive, so you might leave the money in the bank thinking, oh, this is good, I won't spend it. But on the flip side, when an economy is slowing, like the UK is, we've had some GDP figures out saying we're down about 9.9%, which is a hefty reduction, a hefty drop. It would reduce interest rates because that makes our borrowing cheaper. So I'm paying less on my mortgage, so therefore I've got more in my pocket and I'll go and spend it. Or if I've got savings in the bank, I think, well, crikey, that's not doing very well for me. I'm going to pull that money out and I'm going to do that extension. I'm going to buy that buy-to-let property. I'm going to invest it in the stock market. And money flowing through the system stimulates an economy. Now, at negative interest rates is an extreme version of that. So you've gone down to zero and then you're going negative. So it's the extreme version of that. Have we ever done this in the past? The Bank of England, which was founded, I had to look this up, I don't know this off my head, but it's pretty impressive. 27th of July, 1694. So 27th of July, 1694, 327-year record. It has never had negative interest rates. So from that, you could say, well, it's unlikely then. And it is unlikely, but it's not impossible. Okay, so it's unlikely, but not impossible because we've seen Denmark, Japan, Sweden, Switzerland, and the European Central Bank all go into negative territory after the 2008 financial crisis in an aid to stimulate their economy back out. Only two remain in negative interest rate territory. I think that's Switzerland and Japan. Everybody else, I believe now, is at 0%. All the other countries I mentioned are at 0%. Now, the UK is currently at 0.1. So there's a massive argument to say, well, okay, we're at 0.1. What difference does it make if we go to zero, if we go to negative 0.1? You know, it's quite tedious. And this is the sort of view I've got. I'm not sure that they will go into negative territory because if it was that successful, these other countries' economies would be booming. Switzerland currently is at negative 0.1%. 0.75. In Japan, is currently at negative 0.1. So it'll be interesting to see. I could be eating my words. They might meet and they might say, let's go into negative territory, which will be a first, absolute first. So what's the effects on you? That's the most important thing, isn't it? How's it going to affect me and my financial planning? So a couple of things to consider, debt and savings. So let's look at your mortgage to start off with. How's it going to affect your mortgage? If you have a fixed rate mortgage, it's not going to affect it. If you've got a fixed rate mortgage, your rate is fixed for that agreed period. When you come up for renewal of your mortgage, it's what rates are available at that time. Okay. So if you have a variable rate mortgage, most likely it is a tracker rate, and that will track an underlying interest rate. Now that underlying interest rate could be the Bank of England that we just mentioned. Okay. So it could be tracking something plus 0.1, or it could be the retail bank's Halifax standard variable rate or Halifax bank base rate. Okay, so it depends what it's tracking. So it's interesting to look. So if you are tracking the Bank of England and the Bank of England go in negative territory, are you then going to be paid for having your mortgage? It's highly unlikely. Virtually every mortgage that I'm aware of that's been taken out in recent times has a minimum payment rate, or what you also refer to as a collar on the interest rate. So it's capped, or sorry, not capped, it's capped on the high side, has a collar, it's limited at 0%. So you just don't pay anything in interest, just your capital, remember. So it's unlikely, very, very unlikely you're going to be paid for having a mortgage. But use this opportunity, while rates are low, to overpay on your mortgage, to accelerate the debt repayment, because I don't know, I was going to say it can't always be this low, but you never know. It might be new era of just low interest rates. But it doesn't hurt to get rid of the debt anyway. The lowest interest rate mortgage we've seen is negative 0.75 in Denmark. So there was actually a mortgage offered in Denmark which was at negative 0.75. So logically, you would assume I take the mortgage out and the lender's going to pay me 0.75 for taking it out. It wasn't the case after fees were taken into consideration and charge and stuff. The borrower was not paid for having that mortgage. So all these headlines of you get paid for taking money out isn't going to be reality, I don't believe. It's just not going to be the case. Personal loans is another thing. Car finance, these are things that will be effective. Overdraft rates, obviously with the Bank of England rate coming down, it's likely these will be affected, although we've seen overdraft rates skyrocket last year. If you've got an older loan, loans generally are fixed rates. You can get variable rate loans, but generally speaking, loans are fixed rates. So it's unlikely your loan rate is going to change. But if you took your loan out some time ago when rates were higher, it would pay you to look around right now. And we suggest this every year, just doing a bit of housekeeping, doing your own financial plan, have a look around and see if you can get a better rate on your mortgage, on your loan, because the rates have actually come down. And then just borrow the same amount over the same or a shorter term, but on a lower interest rate. It might save you a bit of money. Just be careful of arrangement fees and such like. So not as much as the headlines would have you believe. I don't think you're going to be getting a great payback on your loans or any of your mortgages. So what about savers? So we've got money in the bank, and the Bank of England rate comes down to negative territory. It's already at 0.1, so it's a puny rate of interest anyway. Are we going to be charged for having money on deposit? So the way it works is money's on deposit. All our lives we've believed we got paid interest. We get paid that money. But now the money's on deposit and it's at negative interest rate. Are we going to have to pay to have our money there? And I really find it hard to believe this would ever happen. I really do. You'd have everyday savers like you and I pull the money out probably and just keep it at home in cash, keep it under our bed. And you would have big savers, people who've got chunks of money, pull the money out and leave it in a AAA rated bond. They'd buy Microsoft bonds, for example, and just leave it there because it was safe. The company's not going to bust, and it's safer than it is at home. So the banks would then lose so much money flowing out. There would probably be capital adequacy challenges. So I can't really see it happening there either. So although the headlines might get you sort of excited, I've never been in this territory. The Bank of England never have either in 300 odd years. So we'll have to wait and see what happens in reality. But my money's on not a lot. Not a lot. I think you'll find Bank of England, bank base rates will come down to zero. And I think they will probably improve lending terms. So they will start lending money a lot more fluidly because they're going to be charged if anything's deposited on the Bank of England, you see. So you might see, and that will then spur the economy, wouldn't it? You know, money spending goes out. So although the Bank of England might have negative interest rates, it doesn't necessarily mean your retail bank will pass on negative interest rates to you. Okay, so 5 things you probably didn't know about interest rates in general. Okay, so number one, the highest interest rate set by the Bank of England was in October 1981. Now, for anyone who had borrowing back then, have a think what you think the interest rate went up to. I'm just going to pause for 2 seconds. 15%, 15. So you imagine that, 15%. Now, when I took my first mortgage out, which is about 1995, I think rates were about 7% then. I remember doing a presentation to Nationwide about mortgages, and this cohort was their younger generation. It's almost like the Gen Zs, is it? Who are trying to get on the housing ladder, that kind of thing. It was mainly geared around that. And I explained to them how expensive my house was back then versus now. And although the capital value was a lot more expensive now, a lot more expensive, like double, the monthly payments, from memory, are about the same. So it just shows you that interest rates have really, really come down. Second thing about interest rates, the largest interest rate reduction was at the end of 2008. You remember that was the global financial crisis, which in Australia they always referred to as GFC. It's the GFC, when the bank reduced its interest rate by over 4% in 5 months. That was crazy time, crazy time. Number 3. March 2020, the Bank of England base rate was reduced from 0.75 to 0.1. What happened in March 2020? It's the outbreak of the coronavirus, wasn't it? It's when it also went crazy. The stock market fell 30%. Bank of England dropped interest rates from 0.75 down to 0.1, and we're where we've been until today. And we're waiting now to see whether we go in negative territory. Number 4, have a think where have got the highest central bank interest rate and then what it might be. So where has got the highest interest rate? Venezuela, and the rate is 38.15%. Now that's just crazy, isn't it? They have inflation skyrocketing out there. It's going crazy. So they've increased interest rates to try and curb it. And then number 5, Japan, Denmark, Switzerland all have negative interest rates at negative 0.1, negative 0.6, and negative 0.75 respectively. I missed Denmark out earlier on in the main body. I forgot that. So, other things in the news this week. Halifax, staying on the property kind of interest rates, always linked to property, really, don't they? So, staying on the property ladder point of view, Halifax have said that the UK house prices sprint could be running out of steam, as the lender's latest survey showed prices fell 0.3 in January. It's the biggest fall since April 2020, although they're still up 5.4% on the year. Access to the UK, across the UK, the average property price stood at around almost £252,000. So it's interesting, isn't it? It's like they've just picked a period of time running out of steam. Do I think it's running out of steam? I think what we had is a rally beforehand, a run in the property market, and it's drops in interest rates, stamp duty holiday, all these things coming together, and we're now just seeing a breather. You know, when you go for a sprint, you get tired, you need a breather. So I don't really see any sort of property market corrections, but there's no real reason to, unless we see significant rises in unemployment, which in the moment it doesn't seem to be the case. It's only limited sectors that are being affected so badly. The US, Dow Jones, S&P 500 and the NASDAQ have all hit new highs recently, and there's lots of talk about have they peaked? Is this something going to go wrong? We had the shake off from the GameStop jitters that was induced by the short selling. If anyone's interested in that, let me know. I can always do a session on it, but I think it's been covered in the media most places. And then obviously Bitcoin hit a new high after Tesla placed 1.5 billion of its funds in the cryptocurrency, which really surprised me. But hedge fund managers are buying it, so we'll have to wait and see. Q&A this week, questions that I had in from readers and listeners. If we get negative interest rates, should I pull my savings out of my account? Hey, no, don't pull your savings out of the account. If we go to negative interest rates, it doesn't mean your retail bank will go negative, and it doesn't mean you'll be charged. You are protecting your money by holding it on deposit. Remember, we only keep our emergency cash, which is defined as roughly 6 months of your expenditure, plus any planned spending over the next 3 years on deposit. Because it's being eroded by inflation. It's just a safety hole. It's an insurance. And also bear in mind, it's also protected under the Financial Services Compensation Scheme. So you've got £85,000 protection there. If you bring that money out and keep it at home, you get broken into, you have a fire. There's no way of protecting it. Second question. Is this another bubble in the stock market like 2000? I hear all the tech stocks are reaching new highs. Should I sell my investments now? Hey, look. We always get new highs. That's why a stock market rises. We always get new highs. And at periods of time, there will be a retracement where the stock market pulls back and takes a breather, just like I said about the property market. But even if you sold your investments now, tell me, when would you get back into the market? It's just not possible to time it. And what you need to do is have a long-term time horizon. You need to have at least 5 years, maybe 7, until you need to access the money. And then just invest for as long as you're able to. Invest in good quality stocks or a global index fund, and just sit tight and allow the bumps and rides to ride itself out. Now, I'm a human being, okay? So I have emotions just like you and everyone else. So when the market pulls back and I see my portfolio retrace, you get a feeling. But you then have to refer back to your investment policy statement. You have to refer back to your intention, what your agreement is. And that you said that it's going to pull back. And I know it's going to pull back. I'm just going to allow it to ride itself out. And just don't look at it. If you feel that you need access to an income, ensure you've got at least 20% of your portfolio in fixed income bonds, short-term fixed income bonds. That will give you about 5 years of income at 4% to ride through any storms. But if you're just investing for growth, just allow the money to invest, and always have a 5 to 7 year time horizon. And if you're needing the money within 5 years, you really shouldn't be in the stock market. Just start phasing it out over time, because it's too much volatility for you to be sure that you'll have more money there when you need it than you do now. Okay, Smarter Spender. This section of the show is sponsored by Idelo, the price comparison website. And I just love the stuff that they supply to us. So what they do is they tell us what's dipping in price. Because look, guys, spending money is not bad. I don't want you to stop spending money. Spending money is part of life and it's part of enjoyment. And buying gifts, we had Valentine's Day just come. You buy gifts and people are happy and it's great. But spending other people's money, so spending on a credit card that you're not going to pay off, or on borrowing money, isn't good. Okay, I think the only reason you really should borrow money is to buy a house. That's about it. So, if we're going to spend money, let's be smart about it and get the best price possible. So that's what the Smarter Spender section is about. It's about just looking, saying, okay, how much do we need? How much can we get this item for? Let's get the best price possible. And I think Idelo is probably the best site, an app, to do that for you. Now, they give us each week different things. So this week, they've given us what's likely to dip in price this week. And they've gone through some things like ski wear. That's the thing we used to do in the winter months, remember, before we were on in lockdown. Sunglasses. So ski wear is now at 12%. Sunglasses, 9%. So just think about this. You are going to go skiing next year if you're a skier. So is it a good idea to get some ski stuff now? You're going to go on holiday in the summer, whether it's in the UK or not, it will sun. Do you need some sunglasses now? But a couple of things that I really liked was slow cookers. They're down 11%. Now, my best purchase in the last lockdown was a soup maker. And we have a slow cooker, which I absolutely love. Yeah, maybe that's an option for people. It's down 11% on last week. And then winter boots, down 15% on average than last week. Now, winter boots could be a long-term save, right? Because we're coming out of the winter months now, but it's going to turn winter again. So 15% is a good saving. They think that people are going to be buying football boots. Yeah, in fact, a brand new pair of football boots right now, you would save as much as 43% than buying in the most expensive month, which is November. So it just shows you the data and the information they have on this site is amazing. The thing I like about Idealo that a lot of other sites don't have is the price history. So you put in the item that you want, and you can look historically that actually it dips every, so we're in February at the moment. You could say, oh, it dips every April. I'm going to hold off for a couple of months. I'm going to buy it in April. And you can register your purchase there, and it'll give you a price alert when it hits that price. So go and check out the site if you don't use it. I think it's a great thing. And the other thing, I think they're quite cheeky, but the other thing they're saying is that this week we reckon the UK consumers will be buying baby items, which I did think was quite cute. We're 11 months on from the announcement of the first lockdown, which means babies who are being born now are lockdown babies. I don't think that's right. You shouldn't call a baby a lockdown baby, but it is quite funny. What else to do? We have nothing else to do. Hey, let's make babies. Yeah, let's go and check out the stocks to see what we can buy. It's on bargain at the moment. But yeah, it will be interesting to see what the baby numbers are like over the next 9 months or so. Yeah, that will be interesting to see if there were actually a spike in births because of the lockdown. Hey, thank you so much for listening. It's been always a pleasure. Please keep sending your messages in and your questions in. And if there's anything you'd like me to cover most specifically, then just give me a shout. I'm very happy to do that. You take care. Until next time, my name is Warren Shute, and this is Financial Planning for the Nation. If you haven't yet subscribed to my channel, please do so. There's a great number of back issues to go through, and remember, what makes us different on your financial journey is the support with access to downloads and templates on warrenshute.com, the YouTube videos and podcasts, as well as access to me, a multi-award winning certified financial planner and certified international coach. So please do engage, and let's get your finances sorted together. Thank you to Idealo for supporting this show and for you for listening. The Money Planner is edited and produced by the amazingly talented Vince Wakeman at Avando Systems.